In this video, I'm going to show you how to account for a change in accounting principle. So a change in accounting principle is when a company switches from one GAAP method to another GAAP method. For example, if a company said, hey, I don't want to use the percentage of completion method to account for construction contracts anymore, we instead want to use the completed contract method. That would be a change in accounting principle. And you would account for it retrospectively, which means you would go back and change the prior period's financial statements. Then you're also going to make an adjustment to retained earnings, which I'm going to show you in a moment. You would do all of this unless it's impracticable to do so, in which case I'm going to have another video to show you what you would do then. But let's jump into the basic change in accounting principles. So the disclosures are going to be the nature of the change. For example, we're switching from weighted average cost method of inventory to FIFO, the reason for the change, and the years that are going to be affected by the change. Now, once you've made those disclosures, you have to go back and say, okay, what would the financial statements have looked like the past few years if we had been using this new principle all along? For example, let's say the company, they disclose, they've got income statements and financial data for 2017, 2018, and 2019 fiscal years. So those are the 3 years that they disclose, and they make the change to an accounting principle in 2019. Well, they would have to go back and say, okay, in 2018, in 2017, had we been using this accounting principle right now, let's say they had switched to FIFO, let's say we've been using FIFO all along, what would the financials have looked like in each of these periods had we been using FIFO? Now, if you might say, well, what if the company was in existence well before 2017? What if the company was founded in 1980? Do we have to go back and make financial statements for every single year and redo them and present them to the investors? No, you just redo the ones that you're presenting normally. Now, everything prior to the earliest year, which in this case is 2017, because we said they're just going to present these 3 years of data. Everything prior, so let's say 2017, let's say they use the calendar year. So January 1st, 2017 was the beginning of the earliest year presented. You basically go and say, okay, everything that happened before January 1st, 2017, 1980, 1981, 1982, and so forth, what is the cumulative effect of everything that happened prior to January 1st, 2017? And then you go and you book that cumulative effect to retained earnings. You would also make an adjustment to any asset or liability accounts, like for example, inventory. So let me show you how we do this with an actual company. So let's say we got a company that switches from the average cost method, so you're using weighted average cost to account for inventory, and then you say, you know what, we don't want to do that anymore. We want to do the FIFO method. So now we're going to have some changes because that could affect cost of goods sold, and cost of goods sold affects the company's profit. So let's take a look. Let's say we've got our pre-tax income over here. Let's focus on this to start. And we've got, so let's say we're 2 fiscal years to keep it simple, 2018 and 2019. Let's say those are the only fiscal years the company plans on reporting for. So we've got for the year ended December 31st, 2018. We've got what the pre-tax income would have been when they used weighted average cost method. They reported $200,000 of pre-tax income. But now we go back, remember we recast the financial statements and we say, what would the pre-tax income have been had they been using FIFO all along? And we say, okay, well, it would have been $230,000. So now we are restating the financials of the prior period. So that if we had been using FIFO in 2019, we would have had $340,000 of pre-tax income instead of $300,000, a difference of $40,000. And in 2018, it would have been $230,000 instead of $200,000. So FIFO's leading to higher pre-tax income. So here's our differences here. Now, remember I said that we go back and we have to say, okay, well, what about what's the earliest year presented? In this case, 2018 is our earliest year. And so January 1st, 2018 is the beginning of the earliest year presented. So the beginning balance of that, the retained earnings as of January 1st, 2018, we're going to have to book the cumulative effect of anything that happened before this date. And you say, how will we know that? Well, here we've got the pre-tax income. Prior to that, we had $800,000 using weighted average cost. This is everything prior to January 1st, 2018. But then when we restate using FIFO, we're not going to present all those prior year's financials, but we just note that, okay, pre-tax income would have been $900 instead of $800,000. So it's a difference of $100,000. So you might be thinking, hey, just add $100,000 to retained earnings because clearly FIFO is increasing profit by $100,000, and so profit affects retained earnings. But remember, this is pre-tax income, okay? So if pre-tax income would have been $100,000 higher under FIFO, that does not necessarily mean net income would have been $100,000 higher and retained earnings would have been $100,000 higher. Why? Because when pre-tax income is increased by $100,000, taxes also increase, right? If your pre-tax income goes up, your income tax expense will go up. So let's assume we had an income tax rate of 20%. Then 20% of $100,000 is $20,000. In short, we would have had $100,000 more pre-tax income prior to January 1st, 2018, had we been using FIFO all along. But we also would have had an extra $20,000 in income tax expense. So the net effect on net income and then retained earnings is $80,000 prior to January 1st, 2018. So this is the adjustment. It's going to be $80,000 that we're going to have to make. That's what I'm talking about here when I say make the adjustment for the cumulative effect. So let's take a look. Let's take a look at our retained earnings. So here we've got 2018, January 1st, as reported. So that's before the cumulative effect, before making that adjustment. $50,000 was the beginning balance of retained earnings. But then we take this $80,000 here, okay, and we take it and we put it right there, and we're going to add that. We're basically saying, hey, if we had been using FIFO all along, net income would have been $80,000 higher prior to January 1st, 2018, and therefore retained earnings would have been $80,000 higher. So we make retained earnings, this 50 plus 80 is now $130,000. So we got retained earnings of $130,000. And then if you're wondering for the rest of this table, you want to fill it out on your own time. Basically, the net income, I just take the pre-tax income times 1 minus the tax rate. Okay, so if you were wondering now, hey, well, what about the journal entry? Like how would an accountant record this if they wanted to book that $80,000 adjustment? Well, you would say, okay, we're going to have retained earnings clearly going up. Remember, retained earnings is an equity account. It's going to increase with a credit. It's going to increase by $80,000. Deferred tax liability is so this is our tax effect. So we're going to credit that for $20,000. And then we're going to debit inventory for $100,000. So this journal entry here would basically account for what this is the adjustment as of January 1st, 2018. Now remember, we're also going to have to make an adjustment because we look and we see, okay, now for the year ended December 31st, 2018, pre-tax income is higher. And we see we have a $30,000 difference. The pre-tax income is $30,000 higher per LIFO. But then we've got a tax effect there of $6,000, and so then the net effect is $24,000. So we have to make a journal entry for that as well.